Good afternoon, everyone, and welcome to this month's installment of Epic Insight. This is Brian Lenz, Director of Sales here at Epic Retirement Plan Services, and I'll be your host and co-presenter for today's Cash Balance Tune-Up session. Joining us today to ensure that you're cash balance savvy is Matt Pine. Matt leads Epic's Defined Benefit Actuarial Services team out of our Portland, Maine office. He is a fellow of the Society of Actuaries and an enrolled actuary with over 15 years of industry experience. Matt consults with clients on a variety of issues, including plan design, funding strategies, and pension risk management. He received his bachelor's degree in mathematics from Hillsdale College and a master's in applied statistics from Eastern Michigan University. As a quick reminder, you will be muted throughout the call, but if you have any questions you'd like me to run by Matt at the conclusion of the session, I'd be glad to do that. And with that, I'll turn it over to Matt.
Thank you, Brian, and good afternoon, everyone. Thank you for joining this webinar. Today, we're going to do a cash balance plan refresher. So we're going to cover the basic topics of cash balance plan design and leave a little bit of room at the end for Q&A. So maybe just a little bit of background to put this in context. I thought I would share a couple of observations that I've had just over the past year or year and a half as far as what we're seeing with cash balance. And the first thing I'd bring up is the SECURE Act passage has had some pretty interesting implications for cash balance plans. As many of you probably know, the SECURE Act extended the deadline for establishing defined benefit plans from the end of a plan year all the way up until the tax filing deadline for a plan sponsor. So if you think about 2021 and the work we're doing now to establish new cash balance plans for the current year, those can actually be established as late as an owner's tax filing deadline in 2022. And so previously the rules required that the document and the plan had to be established in the current year. So what's notable about that are really two things. One, it gives the plan sponsor and you, the advisor, a little more time to craft the plan, knowing what the owner's year may look like. And then on top of that, and probably more interesting, is that it gives the owner a little bit of insight into the second year. So if you think about establishing a plan for 2022, starting with the 2021 plan year, it can be helpful to know how your 2022 is shaping up. So we found that to be a pretty big advantage for plan sponsors as they're considering adopting cash balance plan. The second item that I think I would bring up and point out is that anytime there's talk about income tax changes or potential corporate earnings tax changes, that really puts some more emphasis on tax avoidance strategies. Cash balance is certainly an opportunity to defer taxes. That's really one of the primary drivers for these plans. And so just what we've seen bubbling around in Congress has certainly brought more attention to the possible benefits of a cash balance plan. And then finally, I think most recently, as many of you probably know, the IRS released new deferral limits for 2022, and we certainly saw that 401k limits were increased. Now the same thing happens with defined benefit cash balance limitations. And what's interesting is that we hadn't seen any increases for the past 2 years with defined benefit plans, but the new limits are quite a bit higher, and so that really gives a pretty big increase to the level of deduction that business owners can achieve with cash balance plans. So with that said, I think we're going to go ahead and move over to a little bit of just the background and overview of what cash balance is. So first and foremost, cash balance is a defined benefit plan. We often use these terms separately, but they are a subset of the defined benefit plan universe. So they're subject to the same funding rules and regulatory requirements that traditional defined benefits are. But there are some pretty notable differences. The first and the most obvious is how the benefit is defined. And so what makes cash balance appealing is that it's defined in a way that's more similar to a defined contribution plan. So instead of having the benefit be related to final average pay and paid out as an annuity, these plans resemble 401k balances, since there's an account balance and an interest credit. So, the primary characteristic of a cash balance plan is that there's a theoretical account balance for every participant. And then that is credited annually with an amount similar to what you would see with defined contribution. And then interest is provided on those accounts annually. One of the primary differences between defined contribution and cash balance is that the pay and the interest levels are determined in advance. So I say here they're determined in advance by the plan sponsor and actuary. It's really part of the design phase of the cash balance plan to determine what level of funding the plan sponsor wants. But with a defined contribution plan, there's some annual discretion in terms of what the owner can contribute. With a profit sharing plan, it's in some ways tied to the profit of the company, and there's discretion. But with defined benefit, there's sort of a higher benchmark. There's a higher level of permanency. The IRS doesn't like the idea of a defined benefit plan being adopted for a year or two, only to be terminated or wiped away. So there's really some permanence required with defined benefit, although there are plenty of reasons why you could terminate or freeze a defined benefit plan. But when looking at potential candidates, there really needs to be a sort of a consistent ability to meet the funding objectives. One of the brightest characteristics of these plans is the ability to take the benefit as a lump sum. Historically, defined benefit plans used to pay benefits as an annuity, and that could be difficult for different reasons, but most difficult is for a participant to understand the value of the benefit. So when a benefit is defined as an annuity payable at retirement, it's difficult to put that in context in terms of what that value is to the participant. With cash balance, there's an account that resembles a 401k, and that's the benefit. And then that benefit is almost always paid out as a lump sum, either at termination of an employee or when this plan sponsor terminates the plan. And then that lump sum is almost always rolled over into a pre-tax IRA or the profit sharing plan of the employer. Okay, so the final point here, and this is really where the actuary comes in with these type of plans, is that the contributions are determined by the actuary, and this is, again, in conjunction with the plan sponsor. Contributions are made by the plan sponsor. There's no employee contributions. And even though there's a set pay credit schedule, which certainly helps with budgeting and understanding what the anticipated cost of the plan is, there is an actuarial valuation. And part of the actuarial valuation is to consider where the plan assets are. And so if there are pretty significant swings in assets from year to year, it can change the contribution. Although in general, what we find is that typically the pay credit, the sum of the pay credits, tends to be a good proxy for the annual contribution. And even more, there's generally a range of contributions. There's a minimum and a maximum contribution. And so there are opportunities to pre-fund credits when there may be a good year. And then there are also opportunity to maybe fund a little bit less in a year where maybe the cash flow isn't as strong. So there is some flexibility in the contributions. And again, that's the role of the actuary. Okay, so reasons to establish a cash balance plan. I think the answer to some of you may be obvious, and it's certainly the tax benefits are primary. But here's really how I think about maybe the three primary reasons to establish a plan. The first here, and I would not say this is the primary reason, this is probably the most overlooked reason, but it provides a benefit to employees. In this day and age, we've seen plans that have been happy to adopt cash balance plan because it does provide an additional benefit to employees, and it can be a retention tool. Even more so, there's a certain value provided with cash balance that's often overlooked. If you think about a pay credit going to an employee that's say 3 or 4% of pay, and let's say that plan provides a 4% interest credit. An annual statement's going to show that 4 or 3% pay credit provided to the employee. But in reality, the cost to the employer could be less if they earn, say, 6 or 7% annually on their investments, and that sort of outgrows the interest credit. Then in a sense that benefit is really being provided by the investment growth. So there's a value in these benefits that is often overlooked, but recently we've seen a little bit more emphasis on retirement benefits just with the tight labor market and sometimes employers looking to sort of get a leg up on competition. The biggest driver, though, for adopting plans is the tax benefits, and particularly for small business owners. If you think about the baby boomers and these individuals who are maybe small business owners who've worked a while to create a profitable company, are past their peak spending years and maybe looking to put more money aside, there's really no greater opportunity for deferrals into a qualified retirement vehicle than a cash balance plan. So those are really the bright spot for these plans. But we also tend to see maybe younger business owners who are entering peak earning years, maybe small medical practices or a dentist office where these owners are looking to go above what they can get through profit sharing alone. And that tends to be a pretty decent sized segment of new plans as well. And then finally, and also somewhat related to the second topic here, are partnerships. So partnerships, whether it be for law firms or medical groups where you may have multiple partners, even 50 partners. These are extremely popular in those types of settings. Again, for the same reason, is that it allows the owners, the partners, to put away an amount of deferral that's far beyond what you can get with a profit sharing plan alone. Okay, so moving on to the numbers here. As many of you know, the IRS did update the deferral limits for 2022. For most of us, it's pretty clear what the deferral limits are for 401k contributions. We saw those increase. In addition, we saw the profit sharing amounts increase. So in total, an individual under age 50 can save about $61,000 with a defined contribution plan, up to $67,500 if you're making catch-up contributions. What's not quite as clear is what you can contribute through a cash balance plan. The IRS defines benefit limits for cash balance in terms of an annuity payable at retirement age. So it's confusing and not exactly intuitive what you can contribute. For the past 2 years, that dollar annuity was $230,000 payable at age 62. But this year, that amount increased up to $245,000. So that's about a 6.5% increase. Ultimately, what happens with these plans is the benefit is paid as a lump sum. So there's a conversion from that annuity amount to a present value of a lump sum. And what we're seeing now with the new limits is that the lump sum for a 62-year-old in 2022 is about $3.2 million. So that's about a $200,000 increase compared to where the limit was last year. So it's a pretty significant increase for defined benefit plans. And then that $3.2 million, unfortunately, that can't be earned in just 1 year, but the IRS does allow you to max out your benefit over a period of 10 years. So if you run a cash balance plan for 10 years, you can really max out the available benefit. Anything shorter than that, that amount is going to be prorated. And then further, because that benefit is defined as an annuity at retirement age, there is an adjustment for age. So the younger you are, the smaller the present value of that lump sum is going to be. But ultimately what you find is that once you hit age 50 or even 60, your ability to maximize the cash balance is the greatest. But even at younger ages, like age 40, an additional $100,000 is a pretty noticeable jump over what you can do with profit sharing alone. Okay. So moving on to plan design characteristic considerations. This is one area where your actuary should be doing the heavy lifting. We do like to have stakeholder involvement and conversation between actuary advisors and plan sponsors as needed just at the onset, because designing the plan appropriately can really help provide for a smooth outcome. As I mentioned, the pay credit is determined in advance. Typically, it's either a fixed annual amount or a percentage of pay. Percentage of pay can sometimes be nice if there's some variability in pay, but oftentimes the individuals that are considering defined benefit are making above the qualified pay limit. And so it may be that a fixed annual amount is desirable. Of course, these benefits are subject to all non-discrimination and maximum benefit limitations. So typically what we're concerned about as the actuary is what's the maximum amount. And what I showed you on the last page was the maximum amount, but you can always go lower. And so it may be that somebody is not quite comfortable with setting aside an additional $250,000 a year, and you can always go less. So there can be some customization with these plans. Cash balance plans have a unique non-discrimination requirement of being subject to 401(a)(26), and this requires that a certain number of participants receive a benefit out of the plan. Typically, you can expect that if you add cash balance, if you already have a profit sharing plan, it's going to add a few percent pay annually to the employee cost. So the trade-off is that sometimes you could give the owner an additional 100% of the benefit annually, but there's always going to be some benefit in addition to the employees in order to pass the discrimination approach. Next is the interest credit, and interest credit could probably be a webinar in itself. There are different approaches to providing interest credits, and some of these can be complex. Typically, what we see with small employers is that the fixed rate approach is by far the most common and desirable. Often a 4% or even 5% fixed crediting rate is desirable. If you go higher than that, then there can be a little bit of additional risk in terms of meeting that annual amount. But typically what we find is that 4 or 5% works well with the small business. It tends to also result in a pretty high deduction level for the owners. There are other approaches, such as a bond-based yield, that was popular back when treasury yields were higher. We rarely see that approach used now. And then there's also the actual return on plan assets. This is a bit more sophisticated. It is certainly an approach that we get questions about frequently because of the obvious appeal of using the actual return on investments. There are definitely some complications with this approach that make it less ideal for a small business owner, but partnerships tend to find this approach tends to work a little bit better, but usually with a small business owner, the fixed crediting rate is the most straightforward, easy to understand, and really checks all the boxes in terms of what we're trying to accomplish with the cash balance plan. Okay, so moving on, investment considerations. So what we have here are really probably the topics that we hear about most. We're not investment advisors, obviously, but there are some basic characteristics that we like to share just in terms of investment strategy. So assuming that you have a fixed crediting rate approach, which tends to be the most common with small business, there's always the question of what happens if my asset return exceeds the interest credit rate or falls below. And in general, if it's 1 year, the implications may be very, very small. What you'll find though is that if you consistently exceed that crediting rate, that generally what's going to happen is that's going to cut into your future contributions. So it may not be the worst thing in the world to consistently exceed that crediting rate, but know that it could reduce the future contributions and the future deductions. And if you do extremely well, you could find something where the benefit is actually exceeding the 415 limitation. On the other hand, if your asset return is consistently below the crediting rate, then what you might find is that the contributions increase over time. So that's typically less desirable, in my opinion, than the opposite. So oftentimes a more conservative investment approach is seen with cash balance plans. The other consideration with investments is the time frame. As we mentioned, these plans can be maxed out in about 10 years' time. An owner may have different objectives, different horizon. They may be retiring shorter than that. And so certainly as you get closer to the end point in the lifespan of a cash balance plan, the ability to take on equity risk may diminish. So that's the other point of consideration, is that oftentimes these plans have a finite life, and so certainly being able to understand that sort of the glide path and how you exit the plan and your strategy for investments is helpful. Okay, so I thought I would share a sample plan design. This one really I thought was interesting for a couple of different reasons, but a little bit of the background here is this was an organization with two owners, actually a father and a child, and the older was nearing retirement. They had 3 employees, and all 3 employees were well paid. This particular organization provided a pretty strong profit sharing plan to begin with. So ultimately, we were not targeting giving employees the minimum here, but really trying to maintain what they had earned under their profit sharing plan alone. So with this plan, we were able to add cash balance really with no additional cost to the organization other than just the administration fee for the cash balance plan, but no additional employee costs, and then increase the owner contributions or the owner deductions. So ultimately what resulted is a plan with about $500,000 being deferred between the 2 owners, and an employee cost of about $45,000. So 92% of the benefit here was really sticking with the owners. And these are the type of plans that are slam dunks. And really what we see is that you may have business owners who are approaching retirement, and oftentimes the demographics just seem to work out. There are a variety of different situations where cash balance can look good. There are some situations where it doesn't. Maybe there are too many employees, where the cost of adding the plan is just too great because of what would be provided to employees. But this is one illustration that really just hits home the potential for the plan. Okay, so at this point, I'm going to turn it over to Brian to take us through the next few steps about getting started with cash balance.
Yeah, thanks, Matt. Obviously, this can be a complicated subject matter, but we'll do everything we can at Epic to make it as easy as possible for you to deliver the value of a cash balance plan to your clients or prospects. Just to reiterate something Matt touched on earlier in the presentation, a couple of kind of key indicators to look out for potential candidates. If you have clients or prospects who have consistently high earned income and the ability to consistently defer a significant amount of that money, obviously they would be a candidate, and they're probably the ones asking you how can I save more on taxes. If they already sponsor a 401k and profit sharing plan and would like to defer more, again, and are willing and able to potentially give more to their employees, that's a good candidate. And the illustration Matt showed didn't require any additional cash balance contribution to employees. That isn't necessarily typical. Usually we do see a few percent that would get allocated to employees in that cash balance piece on top of a plan you already have in place. So good to look out for. We also see a pretty good number of solo combo plans, as in sole proprietor either has or is willing to start an individual 401k plan and couple that with a cash balance plan. Those can be great for those individual sole proprietors who are bringing in more than about $250,000 annually. At the end of the day, we don't expect all of you to want to be or to become experts in cash balance. If you're even curious, you just get a hint that it might fit, certainly reach out to your Epic sales consultant or relationship manager, and we can triage with Matt and the defined benefit team to put some numbers together for you to assess whether or not it's a fit for your client. On the investment side, Matt talked a little bit about the various crediting rate options and investment concepts that tie to that. From a functional perspective, there are really two approaches. You can hold and manage the cash balance assets at the custodian of your choice, and you're going to manage that brokerage account or other account type, and just make sure that our DB team is linked up to get statements so they can do their work. If you have models set up through Epic and you have a model, perhaps a more conservative model that might fit for a 4% crediting rate, for example, we can also set up a cash balance plan to be automatically traded through our record keeping system with one of our custodial partners. So if that sounds like an easier option for you, we can make that happen as well. And Matt and his team will take care of all of the benefit payments out of those plans. And lastly, I'll just point out, if the investment side of things doesn't sound like it's in your wheelhouse, we can certainly get you set up with an investment manager to take care of that piece and target that crediting rate for you. Matt, you can jump to the next. Oh, all right. So at this point, we'll open it up to questions. One thing that has come in already, and of course you will receive a copy of the presentation as well as a recording of the session to revisit at your convenience. I'll also throw out there that we are happy to engage in these types of presentations or scaled back versions of them for your client base or prospect base. So we'd love to talk to you about getting an audience and delivering a cash balance presentation either to your business owner clients or centers of influence, things like that. Happy to make ourselves available virtually or in person at some point here when that returns to normal. Matt, one question that came in, just any other, you can kind of go back to my slide about things to look for with cash balance candidates. Are there any other buzzwords or scenarios that you typically come across as an ideal candidate, or just things that advisors should be listening for and saying, hey, have you considered cash balance?
Yeah, there is. Typically, and what we'll find with most potential prospects is there's some sort of professional service organization. So whether that's medical related, law, accounting, that's not an exclusive list, but typically what we find is that in those type of industries, they tend to fit the mold best. There may be a doctor and a few employees, or dentist and a few employees, or a law group with maybe 2 or 3 lawyers and no employees. And so I look out, or we typically find that professional service employers tend to be the ones who are most likely to go with cash balance, although that's not exclusive. We do see other types of professions make this work.
Thanks, Matt. Some more technical questions coming in. Does the deferral amount increase as someone ages above 65, and does it level out at any point?
Yeah, that's a good question. It actually, it starts to decrease, and the reasons are sort of actuarial in nature. But ultimately, once you are above 65, potentially it could start to decrease. It really depends on how long you've run the plan, but it generally, the most potential, the highest payout occurs at age 62. There's not necessarily an adjustment beyond that, so it doesn't really keep growing, unfortunately.
Thanks, Matt. A related question: if one of the partners in a business is 75, are they still able to actively participate in a cash balance plan, or would they have aged out?
Yeah, that's a really good question. The answer is that they are. And what's really interesting is that with the 3-year cliff vesting, it actually, there's a 3-year window where required minimum distributions would not be required. The limits for a 75-year-old are a little bit different, but typically they're still significant. So it's not uncommon to see a plan set up with somebody who's over 70 or 75, and sort of the added bonus is that you're exempt from required minimum distributions for the first 3 years because of that 3-year cliff vesting.
All right, thank you, Matt. going back to the illustration you showed, or I guess just more generally, you were in the 90% benefit to owners on that one. Is there a rough threshold of benefit to owner that you're typically seeing people say, yeah, this is a go versus not? I know each case is different, and maybe some may be more inclined to kick in money for their employees than others, but do you have a general rule of thumb?
Yeah, typically if we see something above 90%, the economics of it look extremely strong. There are plenty that we see above 80%, and again, it could be pretty compelling for the business owner. Below that, it starts to there need to be other reasons for the plan. So it may be that the owner is happy with using this as a sort of a retention tool, and so an owner may get a pretty large benefit out of the plan. But let's say they have 50 employees, it's just you're not going to be able to have 90% of the benefit go to the owner. So it depends, and it really depends on the objective, but 90 and 80% is fairly common, and below that it really starts to depend on whether there are secondary objectives with the plan.
Excellent. Thanks again, Matt. How often does the IRS allow you to change the contribution credit for a specific group, if at all, and what's the deadline for doing that in a given year?
Yeah, that's a good question. There's no rule that I'm aware of. We talked briefly about the permanency requirement, and there are two, I guess, ways to think about it, or different schools of thought. And one is 3 years, one is 5 years. It's really it's not clearly defined, other than a couple of revenue rulings from the IRS that address it. Our personal take is that I would not amend the plan within 3 years of adoption unless something was absolutely necessary, like retirement or bankruptcy. Those are always legitimate reasons. But to amend it shorter than that to reduce the benefit, I think could be construed as maybe that plan was not really permanent from the start. So I think you have the ability to do it. It's just not something that I would do with much frequency, but know that if you did start and ultimately the objectives of the plan change, it's legitimate. But getting too frequent with those type of amendments, I think, is risky.
Excellent. Thank you, Matt. And last, we'll close with a quick case study that came in. One of our audience members has a sole proprietor, Schedule C filer client who is a farmer and has typically had significant income from crop sales, has often purchased equipment for tax savings and doesn't want to do that anymore, but has contributed to a SEP IRA in the past. Wants to defer more, is an individual 401k coupled with a cash balance plan something for someone in that profile to take a look at?
Yeah, that actually sounds like a fairly good one to investigate. What you may find is that the benefit would ultimately be skewed towards the cash balance plan. There are certain deduction limits when you combine a 401k with a cash balance plan, but solo cash balance plans are some of the best, just in terms of simplicity, 100% of the benefit going to the owner. So sometimes there can be quite a bit of benefit for a solo business owner to look at cash balance.
All right. Thanks again, Matt. That's all we have for questions for today. And as I mentioned, we will, over the next couple days, get out to you a follow-up email with a link to this recording as well as the slides we presented today. And in the meantime, we'd love to partner with you to take a look at any cash balance opportunities you may uncover. So thanks again to Matt, and thank you all for tuning in and for your ongoing partnership. We hope you have a wonderful and safe Thanksgiving holiday.